Thank you for tuning in to the Crystal Clear Finances YouTube channel. We're glad that you're here. If you enjoy what you hear, then give us a thumbs up and subscribe so you can always receive our new content and that you can have confidence for every financial decision. Enjoy. Welcome to Crystal Clear Finances. My name is Crystal Langdon, certified financial planner, qualified kingdom advisor, fiduciary, founder of Crystal Clear Finances, and your host for the next 30 minutes. And I understand that finances can seem confusing, especially when you don't have a strategic plan to follow. You can feel alone trying to figure it out. But working together, we can help you have confidence for every financial decision. Well, we have been spending the month of July going over the importance of, we can respond to what's going on in this craziness of life. We just don't want to react. And there is a difference. And having that inner mental fortitude to be able to evaluate and look at what's going on and then make the decisions and choices, the little adjustments that are necessary, is important. So we've spent the first 2 weeks talking about the facts of, how do we evaluate? What are some things that we can be doing right now? We talked about the fact that we can look to see the amount that we're withdrawing from our investments. Do we really need to take that much? And then the second thing we talked about was, if we do need that much money coming out, can we take it from someplace else? And we talked about last week, we could probably, if done properly, take it from life insurance because of the cash value in life insurance. And I've had some calls that people say, I just don't understand how that works. Well, I know that there is a lot out there on the internet for both positive, there's a lot of good, and there's some negative. And that's why one of the best things to do is sit down with a certified financial planner, someone who is licensed and skilled and trained in the area of life insurance. Not just took a test and became a life insurance agent and needs to make you a sale, but someone who uses life insurance as one of the keys for creating wealth, because life insurance can position you for those unexpected events in life, but it also can position you to take advantage of opportunities in life. So what I'm going to do is in the first part of this program, I'm going to demonstrate on our software that you can see here on our YouTube channel, but don't worry, those of you who are listening via our radio program, I want you to know that I'm going to talk you through this so that you can see the benefit of this, but I want to talk through how individuals can use life insurance to face these expenses during a downturn in the market, and how they can also use this downturn in the market to have an opportunity and take money from a life insurance policy. And again, you're going to want to talk with your financial advisor. You're always welcome to give us a call at 518-433-7181. So I'm going to go ahead, I'm going to turn to my screen, and I'm going to show you an example. And remember, we always use our tanks. We have our yellow tank of investment, and we have our green tank of savings, which we now know is very often whole life, dividend paying, cash value life insurance. And so what I'm going to do is show an example that if there is an expense that comes up, maybe, just maybe, in the middle of all of this craziness, wouldn't you know it, your car dies and you need a new one. And you don't happen to have 50, 60, 70,000 laying around in your local savings account to pay for new cars. And that's not even talking about high-end cars. We're just talking about, have you seen the price of cars and trucks lately? That's a whole nother program. But let's pretend that you have an expense that comes up. So I want to show you what that actually looks like if I can press the right buttons on my computer. And what it literally shows is that in advance, before we need money in our life insurance, we begin to fill it. We have money that comes in for the form of a paycheck. We know part of it goes out. Those are the little red chiclets you see that are being paid to taxes. The blue is your income that's coming up, and it fills your life insurance policy. That's your savings that you have. And when we're looking at the picture, we can see that the green is representing all the money that you can touch, which is usually money that wasn't supposed to be used for the premium. This is the extra cash value in there, and you can see the death benefit that's in there. And what happens is, as the cash value increases, your death benefit increases as well. Now, when we continue to move forward and we say, okay, I've got a need that comes up, then we go to the life insurance company and we say, hey, look at all this green cash that I've sitting in my cash value. I don't want to touch it. I want to use your money. And since you owe my family hundreds of thousands of dollars of death benefit, depending on your policy, I want to be able to access some of that from you. And so you literally take money from the life insurance company because they're leaving your money alone to grow uninterrupted, tax-free with compounding interest. You take that money and you meet that expense, whether it's a car, whether you had to do a new roof, whether you had to put Susie through college, whatever the case is, now you have a place where you can collateralize it. Now, I've used this word 3 times now in the month of July. Collateral capacity is how much resources do I have that I can borrow against, that I can leverage against, so that I can have my cake and eat it too. Many of the wealthy call it using other people's money. And because yours is growing and doing so well, you use the life insurance companies. Now, I'm going to pause here for a moment. A lot of times people say, why would I ever do that? Well, if you are used to getting 0 to 0.5% in a local bank, well, then of course it seems to make sense that you would just use your own money. You're not making any money with your money. But if you begin to position your money in a way, just like the wealthy do, where your money actually makes more money than it costs to borrow and use someone else's, that's when you begin to create opportunity and wealth in there. So what we're looking at on this screen is literally showing that, hey, you've taken time to put money to build your account up. You needed the cash value that was in there. You went to the insurance company and said, hey, I need some of that money. You took the money, you met the need, whatever that expense was in life, and then on your own, at your convenience, depending on your cash flow, you work to pay that back. They are not mandatory. And I think that that's so important to see. It's not something that's forced. I remember I had all 3 of my kids in college at the same time. Talk about not good planning. So you had Melanie going to law school, you had Stephanie getting her master's, and then you had my son, and he was in school. All of them at the same time. And to me, I wanted to make sure my daughter Melanie was in a safe place because she was going to law school. And so I paid to make sure there was an apartment that was in a gated community. She literally locked 1 block and she was on that campus. Her safety meant that much to me. So I went to the life insurance company and said, hey, look at these green tanks that I have. Look at how much they're growing. I don't want to stop their growth, but I got 3 kids in college. I need to use some of your money. And when I ran the numbers and saw how much money mine would make and how much money I would have to pay the insurance company, and that I didn't have a forced loan, I could wait till all of them were out of school before I began to put money back if I wanted to me, that worked well. My point in this is, what if I waited until they were all in college and then tried to make a green tank? What if I waited, like many people have now, where the market's down, and then said, oh, I need a green tank? Unfortunately, for many, it's a little bit too late to use it right away. Not too late to start, but too late for this time. Because now we've got to start the process. What I'm hoping this time did, what I'm hoping this downturn in the market is doing, is showing you, yes, it's still good to have investments. It can be good. But more importantly, what I want you to see is, I need to get that green tank in place, because next time the market's down, though we can't guarantee it will or won't, can't guarantee it will follow the pattern it's followed for years, but if the market is down again, you could be in a position where you could access that green tank and be able to meet whatever expenses arise. Now, let's take that one more step further. What I'm going to do is say, what if we use your green tank, your savings, the money that's sitting inside your life insurance growing tax-free and you can take out tax-free? What if we said there was an opportunity? What if someone wanted to do a private equity fund? What if someone said, I think that's really good. Or maybe they saw that the stock market was down and the specific stocks that they wanted, those were on sale. They were selling. You could buy them for half price of what they used to be. Well, what they could do is, yes, they could take lazy money out of the bank. That would probably be the first place to take, depending upon their situation. And by lazy money, I mean money sitting in a bank over 1 month of living supply. So we always want to keep that 1 month there. But any lazy money sitting there that's not working as hard as you, then you take that and we use our lazy money first. But let's pretend in this example that someone didn't have any lazy money. All they had was the money that was sitting in their cash value. An opportunity comes up, they can invest. Literally what they can do is the same example that we saw before. In advance, they had built their green tank. And so they can actually take a policy loan without any restriction. So this is so important. When we're looking to get money out of these green tanks, we don't have to qualify. Do you know if you prepay your house is paid off, and you say, I need money because there's an opportunity to come out. You have to qualify to touch the money in your house. In essence, your house has become a qualified plan, right? It's a qualified house. You now have to qualify to touch all that money you put in the house. And many times people think, well, I'm going to put all this money in this house because it makes my house worth more. Nope, it really doesn't. The amount of money that you pay on your mortgage does not make your house increase in value. It doesn't impact the equity. If all the houses on the street, if your house is paid off, the one next door to you, that's not paid off, and then markets go through the roof, guess what? Usually both houses increase in what the value is. It's not because yours was paid off and yours gets to increase, but the neighbor next door who didn't pay theirs off, theirs didn't. Nope, the boats rise together. So that's something to keep in mind, where it was when you are looking at the money you put in your green tank, you don't have to say, this money is for something I want to do. This money is so I can go to Disney World. This money is so I want to buy a computer or college or whatever it is. You don't have to explain. When you go and you ask, usually within 48, 72 hours, that money's in there and the loan payment comes out. You spend it for whatever you want and you decide how you're going to pay it back in the time frame, if you ever do. Now, what if you say, Crystal, I don't ever want to pay it back. This is so cool. Okay, you don't have to, but when you die, this is the caveat. When you die, if you used $200,000 of your money and you went and bought a private equity or you went and did something, right? You were talking with us here at Crystal Clear Finances and we were showing you opportunities that there and you took money out, you didn't pay it back, then when you pass away, they'll subtract whatever you took out from the death benefit. That's why they're not afraid. They're not afraid if you want to borrow the money because, hey, it's less they have to pay your heirs in the future. And when is money most valuable? Money is most valuable today, right? Your $1,000 could go buy $1,000 worth of goods today. Next week, at the current rate we're going, your $1,000 is not going to be able to buy the same amount of groceries and supplies that it bought today. And we all know that's true. We are living that on a week-to-week basis when we see price changes in our grocery store. So being able to access money to go put in an investment so that investment can hopefully improve in value and grow, and then at your convenience, you could even take the profit of the investment to use to pay back the insurance company. So there's a lot of options when it comes to the importance of how do we navigate this market that we're in. By having the proper green tank in place, we're able to not only handle the expenses that come up through life, but we're also able to position ourselves so that we can take advantage of growth. When you go back and you think of the Depression, you think about the individuals that went in. What did they do? The ones that ended up wealthy. They went in, they bought land, they went in because they had the resources to buy when everyone else was scared. They had the resources to buy and take advantage of opportunities to handle expenses. You know, it's been documented that J.C. Penney used his cash value of his life insurance to pay his employees when the markets were down and money was tight for his business. That's pretty cool when you think about it. Pampered Chef, that's how they started their business. And they even talk about how with Walt Disney, how he was able to access some cash value of his own to help in Disney World because the banks weren't too fond of the idea of loaning money for an amusement park based upon a mouse. But now when we begin to see it, it's such an integral part having a safe tank that's backed up by a life insurance company, that's backed up by a death benefit. Lots of different bells and whistles you can put on it. But my point of this is we had started this discussion saying we don't have to react in this market. We have choices. We can choose to, some of the things that we can do is we can evaluate. We can choose not to make the withdrawals we are, and if we are making withdrawals and we need the money, we can take it from the green tank. If we don't have a green tank, then we can call a trusted financial expert and say, Crystal, I need to get a green tank. I need to understand how this life insurance works for me. And what I look at is it is always better to prepare your resources before you actually need them. So say to yourself, gee, do I think the market will ever be down again, that I'll ever need to have some place where I can pull money from that's safe, liquid, and tax-free? I'm thinking yes, but I'll leave that up to you to decide. So we're going to take a quick 30-second break, and when we come back, I want to talk about the next step that we can do when it comes to evaluating how do we respond, not react. And we'll be back in 30 seconds with more Crystal Clear Finances. And we're back with more Crystal Clear Finances. My name is Crystal Langdon, and we are talking about how we can respond in this crazy world and not react. How we can hold the course, how we can look at what's going on and evaluate, and whatever minor adjustments need to be made, we can make them. Now, I want to speak to that as the point that we're going to have for the rest of our program today. Is many times individuals will say, oh my word, this is so stressful, what I'm going through. In other words, I thought my risk tolerance allowed me to be able to withstand the downturns of the market, but now I'm realizing, no, that's not what's happening. I am uncomfortable. So one of the things I know we're doing with our clients, you can talk to your advisor about this, is we're saying, okay, if there is a situation where a client feels uncomfortable, we are walking through, and this is not a recommendation, but we're walking through any slight adjustments that we can make, we will. And when we are able to come through this situation, and I know for compliance that there's no guarantee that the market will go back up, but what we want to do is when we can get to the place where the market is steady again, then we look at it and we say, should we reposition? And I want to talk to you whether you've put money in the market yet, whether you have money in there now, and I want to talk about this positioning. And so one of the modules I'm going to use here on our Facebook channel is I want to talk about your allocation mix. Because you know what? When everybody is seeing the market go up and everybody's happy and everybody's making money, it's amazing how high risk tolerance everyone has. But what happens is when the market gets crazy, then we see, yeah, this is really what our risk tolerance is. And when we're sitting down with an individual at Crystal Clear Finances, we look at not only what their risk is, where do they want to be positioned, high, medium, or low, but we also want to talk to them about their tax concerns. Is it really not a concern? They think they're going to be in a very, very low tax bracket at retirement, so they're not concerned about being tax-free in retirement. And how about liquidity? Do they need to be able to touch their money, or is their cash flows coming from so many places it's not an issue the way we invest or save their money? And what we do is we sit down, and you can see on our screen on our YouTube channel that we'll sit down with clients and we'll talk to them to see, as far as their account, how much do they want to put in high risk, and for some people maybe it's 10%. How many want to be in moderate risk, and how many want to say, listen, I want 40% of my account, no risk at all. Now, I can tell you this from experience. When the market is down, people say, I want zero risk. When the market's up, people are like, yeah, I can take 30% risk. I can do 40% risk. I'm not worried about the market. But I'm telling you, when you've gone through a market downturn, once you've come through it, is an ideal time to sit down again with your advisor and say, I think I need to rethink what my risk tolerance was because that was too uncomfortable. If you're losing sleep right now, you should be talking to your financial advisor to say, I think I'm not positioned properly. When or if we see a rebound, How can we reposition this differently? So there's one area that we look at. The other area that we're looking at is taxes. How do we feel about the taxes? Now, there are some individuals that say, listen, Crystal, I don't mind paying capital gains. Okay, obviously that's not me. I mind paying any type of tax. Ordinary tax, capital gain tax, doesn't matter across the board. I'd rather not pay anything. But some people say, listen, I want a joint account. I'm willing to pay capital gains. So let's say they want 25% there. They say, well, tax deferred. What does that mean? So tax deferred, when you're looking at this, and I know when I'm putting it on YouTube, you can see underneath the different definitions. But tax deferred basically means, listen, I don't want to pay taxes on it now. I'm going to put it into this investment. When I finally need that money and I take it out, I've deferred my taxes. I postponed my taxes, right? I've postponed them. And now that I've postponed them, I realize I have to pay them whatever tax bracket I'm at. Now, many people, when it's described to them and they really get an understanding of how tax postponement works, they say, yeah, I don't want to be part of that. I don't want that at all. Because it's very similar to this. You know, my son loves Lamborghinis. So let's just run this example. Let's say that a person walked into my office and said, Crystal, I need $1 million. I'm going to go buy a Lamborghini and I'm just running a little short of cash. And I say, hey, no problem. I happen to have $1 million sitting in my pocket here that I just happened to bring to work today. I can go ahead and loan that to you. And the person says, that's awesome. And so we go ahead, I give them the $1 million and I said, but here's what the deal is. When I'm older and I retire, I'd like to get a Lamborghini. You had one. Well, I'd like to. And not only would I like a Lamborghini, but my son, George V, 5, he loves Lamborghini. His wife, Jenna's about to have a baby. I want to buy that baby a Lamborghini. Stephanie has a baby. I'm buying that baby a Lamborghini. Everybody in the Langdons gets a Lamborghini. And since I don't know how much money that will cost, I think this is what I'll do. I'll give you that $1 million. You go buy your Lamborghini. And then when I retire, I need that $1 million back. And then I'm going to figure out how much interest I need on all of that so that I can buy all of us Lamborghinis. And that's what interest you pay. Deal? Well, hopefully you would run. Hopefully the person coming to me in my office asking for a Lamborghini for the $1 million of cash I have in my pocket would say, no deal. But don't we do that every day with our 401k? Because here's the deal. The deal is, hey, you put money in here into your 401k and you don't have to pay taxes. But when you retire, as a government, we're going to figure out what the tax rate in this country is. What does the country need? And then we're going to set the tax rate. And then when you pay back that money that we never taxed you on and you go to take it out, we get to have it at whatever tax rate we said is now viable. And you might say, no, that's not right, but it happens every day. And you do know, because we've shown examples, that with a stroke of a pen, they can redefine what the tax rate is. And so tax deferred, when people understand what it really does, many individuals will say, oh, I don't want any in there, and I don't blame them. So I'm going to say in this case that someone said 0, and then the last option, if you're taxable, tax postponed, or tax advantage, which means tax-free. So most people say, sign me up for the tax-free. I would say out of all the clients we have, 95% of them are like, Crystal, I feel I pay more than my fair share of taxes. Any way that you can help me invest and grow my money, cultivate my wealth so that I can keep it in the tax advantage manner is the path I want. And so we help them set up tax advantage accounts, which is why many times we'll use Roth and many times we'll use life insurance because of the tax-free. Now, the other area that we focused on, is liquidity. Can you touch it? Well, let's pretend if someone has, and I'm just going to put in here, if someone has a 401k, and in that 401k, like many people do, they have $500,000. We know that that is a tax deferred. We know, I'm going to say that the risk is high on that because the way I look at it is this. Unless you understand what you're investing in, and you understand how it works, then if you don't, let me put it this way, if you don't understand what you're investing in and how it works, would you consider that risky? What would you consider if someone says, I'm going to put my money in something I don't understand, I don't know how it works, and I'm going to trust that it will make me money in the end? Would you say that's risky? So I'm going to say that the 401k is risky, and I'm going to say that it's not accessible for most individuals. I am going to go ahead and I'll put in here, and a lot of times we'll write in what individuals have. I'm going to say that they have a Roth and they have money in the Roth, so we know that that would be tax advantage. And again, on that one, unless they know what they're invested in, I'm going to say that that risk is high. And then I'm going to go ahead with the joint account and say, okay, well, how does a joint account work? Well, the joint account, and you can see this online as well, is taxable. And for this one, let's say that they do know what they're investing in. So I'm going to say it's medium, and I'm going to say it's accessible. When I put all the investments for a client into this software that I'm demonstrating on this YouTube channel, I can show them not only what they've said their risk tolerance is, not only what they said their tax preference is, but also how much money they have access to at all times. And what we show them is, this is what you said you wanted. And I literally can say, okay, you said that you wanted to have, all right, 50% over here, 10% over here, and I show how it's broken down. But then I say, okay, and this is what you actually have, and then we put them together. And we show many times, 9 out of 10, that individuals are sitting with the opposite of what they think they have. They think that they have, you know what, I like that low risk. I want to be moderate in the market, very little high risk. And yet when they come in and they show their statements, they are close to almost 100% high risk. And this is where, with working with a financial advisor, whether it's me, yes, I'd love to. I know that for the past 25 years, we've provided financial education. And I would love to work with those who have listened to this and have grown over the years. But even if you're not working with me, being able to go to your financial advisor and say, I know the market's down right now. I don't really want to touch anything. But can we put a plan together that if the market was to recover, I can have this amount of risk, this amount of tax, and this amount of liquidity? That's what you should be talking about. This is a way to respond to what's happening in the market without reacting. Well, I am looking at the clock and realizing, yep, we're at the end of another program together. I want to encourage you to give our office a call at 518-433-7181. Let's schedule a time that we can make sure that what you have is actually what you want, and that you are walking through all this market and world craziness and you're not reacting, but you're responding appropriately. So give us a call, and in the meantime, join us again next week as we continue to provide financial clarity so that you can have confidence for every financial decision. Thank you, and God bless. Thank you for watching the Crystal Clear Finances YouTube channel. If you enjoyed this program, then give us a thumbs up and make sure you subscribe so you never miss an episode. And if you'd like to meet with one of our financial advisors, feel free to give us a call at 518-433-7181 and gain confidence for every financial decision. Thank you, and God bless.